Welcome, everyone. So, in our past few sessions, we've really laid the groundwork, right? We've learned the basic language of business, how to record all those day to day transactions. But today, we're taking a huge step forward. We're moving beyond just being a scorekeeper. We're going to see how accountants become financial storytellers, and we'll do it by using a really powerful tool called adjusting entries. This is how we uncover the true financial story of a business. It's a game changer, really. It's where accounting stops being just about what happened in the past and becomes this incredible tool for making smart decisions about the future.
All right, let's ground this whole discussion in a real-world scenario. Let's imagine a brand new consulting firm just starting out. They've had a really busy first month, and when they check their bank account, they see a $50,000 balance. That feels pretty good, right? A solid start. So, the big question, the one every business owner wants to know, is this: are we profitable? And when you look at that 50 grand in the bank, your gut reaction, your immediate thought is probably, heck yeah. But, and this is a big but, as we're about to find out, the amount of cash in your bank account is just one piece of the puzzle. It doesn't tell you the whole story. Okay, so here's our game plan for today. First, we're going to look at that initial misleading picture, why looking only at cash can lead you astray. Then we'll get into the actual rules of the road, the principles of fair reporting that keep us on track. After that, we'll roll up our sleeves and apply these rules to two major situations: prepayments and what I like to call unseen events. And finally, we'll tie it all together to see how this whole process makes a massive difference when you're the one making the tough calls. All right, let's jump right in. We're going to start by looking at this company's financials based purely on cash. Cash in, cash out. This is called cash basis accounting. It's simple, for sure, kind of like managing your personal checkbook. But for a business, it can be incredibly deceptive because it's not tracking your actual performance. So here's that simple, unadjusted view. The firm got $20,000 in cash from its clients. Great. And they paid out $6,000 for rent. But notice, that's for 3 months of rent. If you just do the simple math, it looks like they made a profit of $14,000. Now, if you're the owner and you stop right here, you are feeling fantastic. You might be thinking about a bonus or maybe buying some new equipment. But this picture is a mirage. It's missing huge pieces of the story. So before we can fix this distorted picture, we've got to understand the rules that make financial statements fair and reliable. These are the core principles of what we call accrual accounting. And it's what's required by GAAP. That's generally accepted accounting principles. You should think of GAAP as the official rulebook for all businesses. It makes sure everyone is playing the same game and speaking the same financial language. Now, this first rule, the revenue recognition principle, is absolutely fundamental. It forces a complete shift in our thinking. We stop asking, did we get the cash? And we start asking, did we earn the money? Do we provide the service or deliver the goods? Let me give you an example. Say you sell a 1-year software subscription. You might get all the cash up front, but you haven't earned it all yet. You earn it month by month as you provide the software service. This principle prevents companies from making it look like they had a fantastic year just by collecting cash early. You have to earn it. And here's the other side of that coin. The matching principle is the perfect partner to revenue recognition. It's all about cause and effect. It says that any costs you incurred to generate this month's revenue, well, they need to be recorded as expenses in this month too. Think about it. The salaries for the employees who did the work this month are a January expense, even if you don't actually pay them until February. You have to match the effort, the expense, with the accomplishment, the revenue. When you put these two principles together, you get a true picture of profitability for a specific period. Okay, let's put this into practice. We're going to start with our first category of adjustments, which are for prepayments. In accounting lingo, we call these deferrals, and that's exactly what we're doing. We're deferring the recognition of an expense or revenue because the cash changed hands early. So here's our first case. On January 1st, the company wrote that check for $6,000 to its landlord. Now, that payment covers January, February, and March. So on January 1st, they didn't have a $6,000 expense. No way. What they did was they bought an asset. They bought the right to use that office space for 3 months. That asset is called prepaid rent, and it represents a future benefit to the company. So let's look at the journal entries. On day 1, when the payment is made, we debit the asset prepaid rent for $6 grand, and we credit cash for $6 grand. See, no expense yet, just swapping one asset, cash, for another asset, prepaid rent. But then, at the end of January, time has passed. We've used up 1 month's worth of that rent, so we have to make an adjusting entry. We debit rent expense for $2,000, that's 1/3 of the total, to recognize the cost for January. And we credit our prepaid rent asset for $2,000 to show that it's been partially used up. We are literally converting the asset into an expense as we use it. And just look at the impact. Before we made this adjustment, our books would show 0 rent expense for January. That's just wrong. Of course we had a rent expense. We used the office all month. But after the adjustment, we've correctly assigned $2,000 of cost to January's operations. And our balance sheet is now correct too, showing that we still have an asset worth $4,000. 2 more months of rent.
Excellent. Now, let's flip the script and look at the opposite situation. These are called accruals. With accruals, the business activity happens first and the cash comes later. These are those unseen events that a simple cash-based system would miss completely.
So here's our next case file. The company's employees worked hard through the last week of January. For that work, they earned $5,000 in salary. But payday isn't until February 5th. Now here's the key. That work they did helped generate January's revenue, right? So the matching principle tells us loud and clear that salary cost is a January expense, period. It doesn't matter when the cash leaves the bank.
So to get our books right, we have to make another adjusting entry. We debit salaries expense for $5,000. That puts the cost of that labor right where it belongs, in January. At the same time, we have to credit a liability account called salaries payable. A payable is simply an obligation to pay in the future. This entry is our way of officially recognizing, hey, we owe our employees $5,000. And again, look at the impact. Before this adjustment, our financial statements are just plain wrong. They'd show 0 labor costs for that week and pretend we owe our employees nothing. That's misleading. The adjusted picture, though, is accurate. It shows the $5,000 expense on the income statement, and it shows the $5,000 liability on the balance sheet. Now we're telling the truth. Okay, now for the grand finale. This is where it all comes together. We've adjusted for our prepaid rent, we've adjusted for our accrued salaries, so let's put the old, misleading cash basis numbers right next to our new, accurate accrual basis numbers and see what a huge difference it makes. I mean, just look at this. It's night and day. The unadjusted report on the left claims a profit of $14,000, but it gets there by overstating rent expense and completely ignoring the salaries. The adjusted report on the right tells the true story. It correctly shows only 1 month of rent expense and, crucially, includes the salaries that were earned. This is the real measure of how the company performed in January. So after all our work, we land on the true profit for January, $13,000. And I want to be clear, this isn't just some academic exercise to get the right answer for a test. This number, this $13,000, is the foundation for every smart decision you're going to make from here on out. And this is why it matters in the real world. Let's do a little role playing. You're the owner and you want to expand, so you go to a bank for a loan. Imagine you walk in and hand the loan officer that first unadjusted report. They're going to look at it and get confused. They'll say, wait, your rent is $6,000 a month and you have 0 salary expense? How is that possible? It looks unprofessional. It shows you don't understand your own business. They are not giving you that loan. Now, imagine you walk in and hand them the second adjusted report. The loan officer looks at it and nods. It makes sense. It's logical. The conversation is totally different. They say, okay, I see what you did in your first month. You're on the right track. Let's talk about your plans. That is the real-world power of doing your accounting correctly. So, as you go on to become managers and business leaders, these are the classic traps you have to watch out for. Number 1, never ever confuse cash in the bank with actual profit. We've seen today how dangerous that is. And then there are the others, ignoring expenses just because you haven't paid them yet, or forgetting to spread out the cost of your prepaid assets. Your job is to be able to spot these errors and insist on getting an accurate picture before you make a decision. And I'll leave you with this final thought to chew on. We've proven that adjusting entries are absolutely essential for understanding what just happened, but their real power is in looking forward. Once you have a true, accurate understanding of your real monthly costs and your real revenue streams, you can start building budgets that actually work. You can forecast your future with some confidence. So my question to you is, how can you use these truthful patterns from the past to predict and shape the future? We'll dig into that next time. Thanks, everyone.